Hey guys, I'm back with part 3 of this series on taxable accounts. As always, this is not personal, financial, tax, or investment advice. It's just for education. So in our last video, I hinted at the fact that understanding how taxable accounts work, such as capital gains treatment, dividends, ordinary versus qualified, can actually be beneficial. Now, I want to zoom out and actually give you one specific case. So say that you are someone who is in your highest peak earning years. Here's one way that you can be thinking about strategizing investing in a taxable account. Now, this is not all inclusive. This is one case. It's not for everyone. And I will highlight the 3 things that make this really important. I just want you to see that there's more to just opening the account. You need to really think deeper. So what I want to talk about today is the technique called custom indexing or creating a direct index. So fast forward to today, we have the most modern AI-driven algorithmic technology for trading that's ever existed. But 20 or so years ago, it would be really difficult for you to own close to 200 or 500 stocks. One would be the technology made it difficult, and 2, there were more fees associated. With fee compression and technology advancement, you can actually have what's called a custom index. So if you think about something like the S&P 500, the 500 largest companies in the US, you can own essentially a fraction of all those companies in the same weight that they are carried in the index, so that your returns are going to mirror that of the index. Now, why is that important? It's because if you were to have a mutual fund or an ETF that is also mirroring that index, you don't actually own the individual securities. So in a direct index, you can. Now, why does that matter? So in any given year, whether it's an up year or a down year, there are so many companies within that index that are actually down, meaning they've experienced losses. So if you create a customer direct index in a taxable account, you can take advantage of what I taught you last week, which is that capital gains and losses and how they work. So what you can do is you can harvest the losses that occurred in that year. And what you can do is either offset a portion of that up to $3,000 a year against ordinary income, or you can then use those against other capital gains, whether it's in the portfolio itself or elsewhere. Now, here's 3 test cases where this type of account makes a lot of sense. Number 1, you are in your highest earning years and you know it's going to continue. So if you're in the highest tax bracket, you want to potentially harvest losses and either offset that against income or offset that against short-term capital gains, because remember, those are taxed at ordinary income rates. Number 2, you experience later a liquidity event, meaning you're going to sell a business that's going to have a large capital gain, or you have real estate and you know those transactions are coming. Number 3, you have wealth elsewhere. If someone inherits this account over the years, they will get a step up in basis. So even you lowering your basis through tax loss harvesting, it's not going to hurt you. Hope it's helpful. I'll see you next time.